Bismillahirrahmanirrahim. Yesterday we discussed up to preference shares. We discussed types of shares, ordinary shares and preference shares. And there are, when you talk about preference shares, that is, you can either redeem or you may not redeem. Redeeming means after 5 years, 10 years, you can take the money back from the company after returning your shares. So that is redeeming. Same like pawning. Your jewelry, you go to bank, you keep the jewelry, you take money. When you have enough money, you go back to bank, give your money and you take the jewelry back. So same like that, company what they do is they issue preference shares. When the project is over, they got all their money, then they can return the money back to the shareholders. So that is redeemable preference shares. There is also irredeemable preference shares. What is irredeemable? Once you invest, alas. Same like ordinary shares, it will be there until the company is there. So you can also have, there are other types of preferences which I am not going to discuss here. Cumulative, non-cumulative, participative, non-participative. This is not in our scope. Then we talk about reserves. There are two types of reserves. Revenue reserves and capital reserves. Revenue reserves are reserves that is generated from your day-to-day operation. Like one good example of this is the profit at the end. This is one example of revenue reserve. These reserves normally used to pay dividends. You have to use revenue reserves to pay or distribute dividends. Capital reserves are a special type. This is created on certain special conditions. One good example of capital reserve is share premium. Share premium is not created as and when you want. It's only when you issue shares it arises. Also there is something called revaluation surplus. We learned this in IA 16. Revaluation surplus, also one example of capital reserves. So here one another example, general reserve. Now many of us who prepare financially in Qatar, they know there is one reserve called legal reserve. You remember legal reserve?
Yes.
One condition in commercial law of Qatar is that 10% of the profits of every year should be transferred to a reserve. And this reserve should continue until the total becomes equal to 50% of the share capital. And then the company has the option to stop. Or if the company prefers to do it, they can continue. But the condition is what? 10% of your profits must be transferred to this legal reserve. This legal reserve you cannot touch. So legal reserve will become an example of capital reserve. Clear? Yeah.
Actually, this surplus, revenue surplus, I was not there. Just can you tell me?
Revaluation surplus.
The revenue surplus.
Yeah. Let's say you have a property, 100,000. You revalue this to 120. Exactly. IA 60. So the 20,000 is the revaluation surplus. So these are reserves. Can we try this question?
So they are distributing the dividend
What is
against
the profit?
500.
500 is the profit. And how much is the share capital?
1000 into 10.
1000
into 1.
1. So the share capital is 1000. Now what they say? The company has two choices as to what can be done with this profit. First one, distribute it as dividend to the shareholders. Other, this profit can be given to the shareholders. Take it.
Okay.
Second option, keep it with us. Maybe we need this money for future projects. So without giving everything back to the shareholders, we keep some of the money for our future new. Now the company deciding, if this company decides to pay a dividend of 10 cents per share, so how much will be the dividend then?
1000 into
100.
100, exactly. So 100 will be dividends that will be payable to the shareholders. So what is the balance money?
400 will be
And this will be retained. Now, if you remember, I talked about that pot. Now, this is the pot, the money that is left over for the mother. How much?
500.
500 minus 100, that is 400. And then, so that's the profit. Next, what they want you to do is, you see your income statement, profit for the year is 500. In your balance sheet, your share capital 1000. Your return earnings. What do you mean by returning?
Profit. 500 minus
Atif, can you bring one chart for the So 500 is the profit that they made it. However,
dividend.
they paid a dividend of how much?
100.
So total is 1400. Is that clear? That. Borrowings. Sometimes you can also call lendings, borrowings. Lendings, I give you, I lend. You receive, you borrow. So this is mainly our liabilities. If you divide, there are two types of liabilities: current liability and non-current liability. The borrowing, you mainly call it long-term borrowing. This is good example is bank loan. You take a bank loan, you keep it with you for next 3 years, 4 years, and then you pay interest, and that interest will become finance cost. So, and then we have what do you think the double entry for finance cost? Finance cost is an income or expense? It's an expense. So you should debit finance cost and then credit
Bank.
finance cost payable. Separately you can show. Sometimes you can add to the loan. Like what you say. Clear? Next we have income tax. what the mechanism in income tax is that you arrive the profit, we call it before tax. You arrive the profit before tax. Now what you do here, where you use the tax law of any given country. For example, Qatar, we have Qatar tax law. Like that, every country has the tax law. According to the tax law, you calculate the income tax. Calculate income tax. You will arrive that amount. And this answer you call it profit before tax. And this answer is you call it profit after tax, sometime profit for the year. So this is what you do. Double entry. Debit, income, tax, expense. Credit, income tax, that's the double entry.
For example, in this case now,
Yeah.
we pay cash, the payable, tax payable. So that time we have to credit cash, right?
Obviously, if you are paying the tax immediately by cash, debit, income tax, expense, credit cash.
Okay. And this is when which situation?
I don't understand.
This is the one you can you go back to the PDF?
Tax payable account by we create.
When are we going
If
to
you are not paying the tax,
on the same time?
yes.
So that time we will put like this. Right?
Exactly. Let's say, for example, you calculate income tax on the 25th of December. You pay the tax on the 15th of January. For the year, this year, you have to prepare the financial statement. Clear?
So then when we are paying, we will credit cash and then we are payable.
Definitely. Can you try this question now? This is a typical question that will come in the exam. You have to prepare for 2015 and 2016. Right. Activity number,
5.
page
377.
37. When preparing its financial statement for the year ended 31st December, Lauren estimated that its income tax payable would be 62,000. See, 2015. I have tax expense, tax payable. So 62,000. So this is you put here tax expense, here tax payable. This is the first entry. Clear now? Now we balance this. This will go to profit and loss of 2015. 2015 profit and loss, I will have 62,000. And this will, we have not paid yet. So we carry forward this to next year. Now, question. What is the question? When you submit something to the tax department, 100% tax department will accept what you give? No. They will review, they will check, they will increase, they will decrease. Now, regarding this, and then are they doing this very fast? They take their own time. So 2015, my tax liability, which I calculated 62,000, we submitted the return to the department, and then when we were about to pay, we wanted to pay in the early part of, let's say, first month of January. They said, no, you have to pay cash 65. They estimated differently. And then, now I have a different number here. Now this different number, see, clearly watch. My estimate 62, my payment became 65. So I have made a provision of 62,000 to make a payment of income tax. My provision is based on the actual payment. I have made an over provision or under provision. I have made an under provision. Clear? How much is this under provision now? How much is under provision? This 3,000 is my under provision. Now we go to tax expense 2016. So this 3,000 will transfer to tax expense, and it will be shown here from tax payable under provision. Clear? Now, you understood?
Under provision?
Yeah, under provision. Under provision. What do you call it in Arabic? No idea? Translate, translate. This is provision. So under provision, then you have to add that word. something different, less. Clear? Now, Lawrence settled this liability on 30 September 2016. See, it's clear. We calculate tax liability for 31 December 2015, but we settled this on that next year after several months. The tax estimate for the next year became 43. Now the same double entry. 43,000 tax payable. That will come here now. Actually, I don't need, I should not balance this. Tax expense. How much it got payable now?
46,000.
46,000. And then carry forward will be 43. Clear? Now what they want?
This
Prepare-
was,
sorry.
this
sorry.
was now, huh?
Additional expense. You don't call it loss. It's an additional expense related to tax.
So but that 3,000, we should disclose in the financial as previous year adjustment or
Under provision. In the P&L, when we are showing, they are asking the tax note, no? So when you are showing the tax note, tax expense 2016 43,000. Under provision 2015 you have to show like, and this much will go to balance sheet as that.
pay.
And one more thing. From this 62,000, we estimated on 31st December 2015. And on the same day, assume, same day, paid 65. So then we don't have any liability, but we will have a difference of this 3,000. Then if you prepare a trial balance for 2016, you prepare a TB for 2016, you should have tax under provision debit balance 3,000. And when you prepare the financial statement for 2016, this much should come there and you should do what you have done here. Clear? This is the comparison between sole trader or partnership and company. Ownership, the proprietor owns the business. Company, there are often a large number of owners who are called shareholders. Liability, the proprietors has unlimited legal liability regarding the business. Members or shareholders have limited liability, which we discussed. Legal status, the business and the proprietors share legal entity through the business is a separate business entity for reporting purposes. The company is a separate legal entity. Management, the proprietor usually owns and manage the business. Whereas members or shareholders do not usually manage the business but appoint board of directors. Profits, the proprietor takes drawings out of the business. Whereas members may take dividends. The directors receive a salary from the company and this is expense. Taxation, business profits are taxed in the hands of the proprietor using the individual tax rates. Income tax is paid on the company profits. You understand the difference of the last point? The last point, if it's a sole trader, you don't have tax for the business. You have tax for that person, Mr. A, Mr. B, like that. But if it's a limited liability company, income tax for the business, not for the shareholders. Statement of financial position. The sole trader, the middle of the statement of financial position is split into opening capital, profits and profits, obviously. The middle of the statement of financial position is split share capital and reserves that we discussed now. Legal requirements, there are no legal requirements specific to a sole trader or partnership. There are extensive legal requirements governing limited companies for annual filings of financial statements. Other, the business is closed to outside investors, obviously. Investors can invest in a company. So with that, this chapter is over. And then we move on to preparation of financial statements for companies. Stop the video and then